So there have been quite a few actually. I think it's less so of a structural force, but really we've found that active investors are becoming ETF users and using ETFs as part of their portfolio as they look to do more asset allocation. So the active ETF really becoming a very popular user. The other big trend is regulation, which you've seen unfold throughout the world, whether it's in the US, in Europe, in the UK with RDR, and in Asia as well. Of course, in Australia, you had FOFA, and these regulatory shifts, they shift the behaviour of market participants. So we've seen the rise of fee-based advice, which of course then has made the ETF an attractive investment option as a building block in a portfolio. Another effect is just simply fee compression, and that if you're looking to invest in a market that is a broad-based index, an ETF is a great alternative because the options are very low cost. You can buy S&P 500 for 4 basis points, so that's a great option to invest into beta. But on the other hand, you still see money going into more complex, opaque markets, and that's where alpha makes sense. So just the real question about value for money. So I think that, you know, each jurisdiction has its own development of its financial ecosystem. So when we talk about ETFs in the context of Australia, I agree with you that you know, ETFs are fairly new here. The industry just recently passed through 41.5 billion Australian dollars. And I think that's really a structural you know, answer. I think there's been a strong home bias here. You've had a very strong equity market. You've had a lot of personal wealth going into, you know, one's house or property. So when you look at those two exposures, and if you've had a bull market where everything has typically been rising over the long term, there's very little need to diversify, and ETFs of course are great tools for diversification. But we've more recently seen a shift, money going offshore, and the ETF just, you know, becoming more well known, and the education process around ETF becoming more widespread. Yeah, it's a really important question because 6,000 ETFs, it's a bit of a jungle out there in terms of product, and not all ETFs are created equal. So at BlackRock, we have a framework of due diligence that we educate investors on, and that really takes you through the journey of looking at an ETF from a performance perspective, from a structural perspective, determining how is it built up, is it physical, is it synthetic, looking at the liquidity, how do you trade ETFs. So really taking you on the journey to give you a framework on how to judge an ETF for its suitability. Look, I think that really depends on your view. You know, I think it depends on your regional views, on your sector views. If you think that interest rates might rise, you probably wouldn't pick a long duration fixed income ETF. If you're worried about geopolitical risk in EM, you probably would steer clear of emerging market ETFs. But I think the great thing is that there are, you know, close to 6,000 different ETFs. So you have the ability to do precision investing. And even, you know, if I would pick out fixed income, you now have an industry which is almost $1 trillion US. There are hundreds of products, and you have the ability to really pinpoint your exposure, whether it be long duration or cash-like, short duration credit. The choice that you now have really gives you that exposure to manage your portfolio in a very diverse fashion.